We're going to take a look at what happens to the S&P 500 during and after inverted yield curves since 1980. Then we'll go deeper and look at what happens to the market during falling yield curves, flat curves, and rising curves. So what's a yield curve? The yield curve is a line that plots yields, interest rates, of bonds having equal credit quality but differing maturity dates. If you were to plot the rates of the 1-year, 2-year, 5-year, 10-year, and 30-year treasuries at any given time, normally the curve would slope upward from left to right, from the short-term rates to the higher long-term rates. The long-term rates are usually higher because the borrower must pay a premium for longer loans, the borrower in this case being the U.S. government. An inverted curve is when it slopes downward. The shorter term rates are higher than the longer rates. Now, what would cause this? Hold that thought. We'll get to it in a minute. I'll be showing charts of the 10-year U.S. Treasury minus the 2-year rate, which is a popular way to view the yield curve over time. That's the blue line. Normally it's above zero, but every once in a while the 2-year rate is higher than the 10-year rate, like it is now, and it flips to negative, or inverted. An inverted yield curve has been a pretty good indicator of a coming recession. This inversion has preceded every recession since 1956, but not all inverted yield curves result in a recession. So to have a recession, you must first have an inverted yield curve. But an inverted yield curve does not guarantee a recession. Got it? It's a little confusing, I know. What does an inverted yield curve mean? It means the market expects rates to be higher in the short term than in the long term. Now, what are the implications of this? In the short run, the market is expecting rates to remain relatively high, presumably to fight off inflation and/or to cool off an overheated economy. But in the long run, the market is expecting rates to be lower, probably to stimulate a slowed economy out of the doldrums. So this seems like a nice setup for a potential recession. Just a little more yield curve talk, then we'll move to the charts. But first, I'm not a financial advisor. This isn't financial advice. If you find this topic interesting, please like and subscribe. So while the inverted yield curve is one signal of a future recession, it also shows how the market expects the Fed to change rates over time. Our current inversion indicates that the market thinks rates will be higher in the short term than the average over the next 10 years. Now, as an investor, you'd be most interested in the effect an inverted yield curve has on the stock market, rather than on the economy. So let's look at all the inverted yield curves of the past 43 years and see what the S&P 500 has done around them. This chart shows the S&P 500 in red and the yield curve in blue. The pink colored areas show when the curve has been inverted since 1980. The yellow areas make it easier to see what the S&P 500 has done during and around the inverted yield curves. Let's zoom in on the 80s and early 90s. The inversion in the early 80s was extreme. During the inversion, the market was mostly down, and when the inversion was over, it went on a long extended bull run. So the super high interest rates seem to have worked, fixed the economy and the stock market. The next inversion was toward the end of the 80s. The market did well during the inversion, but soon after leveled off and took a dip in the early 90s. If I remember correctly, this caused the economy to go into a recession and cost the first Bush the election. The next inversion happened just as the dot-com bubble reached its peak and rolled over in 2000. It was followed by a long, painful drop in the market. Then there was the inversion right before the financial crisis around 2007. This was similar to the late 80s recession in that the market continued to rise, but the following bear market was deep and painful. And now we have the current inversion. It's different from the previous three inversions in that it didn't appear until after a noticeable market pullback. And of course, that little pandemic thing we had. So let's move on and take a look at what the market does as the yield curve falls. It's usually not inverted in this case, but the fall could end up in it being inverted. This is our current situation. Looking at all these times, it consistently coincides with a bull market, or at worst, a break-even market. Our current situation looks similar to the 2012-2013 time in that it was about break-even during that stretch, but there was no inversion back then. It was followed by a long bull market. Or perhaps now is most similar to the quickly falling curve back in 1981, which I didn't even bother marking on the chart because it was so brief. But it could be a good match because it also ended in inversion. It was followed by a nasty extended bear market. Now let's take a look at times when the yield curve has been fairly flat for an extended time. This was the case through much of the 80s bull market and the late 90s bull market just before the dot-com bear market and just before the financial crisis bear market and just before the pandemic, a nice bull market. So the market seems to like extended flat curves until they end. Finally, let's look at what the market does during rising yield curves. The results are pretty mixed, maybe a little dangerous. This was the case during much of the early and mid-80s, bumpy but bullish. Also in the late 80s and early 90s, again bumpy but bullish. The early 2000s also saw this rising yield curve, for mostly a bear market as the dot-com bubble deflated. The next rising yield curve started just before the financial crisis and ended after the market had started its long bull run after the financial crisis. Another short-term rising yield curve happened in the early mid-teens during a nice bullish section of a very long bull market. And finally, a rising yield curve was in place a little before, during, and after the pandemic until the market started to realize that the pandemic stimulus inflation was not transitory. My best guess is that we'll probably have a rising yield curve soon. As you can see, the market has a very mixed reaction during rising yield curves. It was especially bad after the dot-com bubble and financial crisis. Even during the early 80s, the yield curve rise started with a painful bear market before a fairly violent bull market started. So strap in. We could be in for some rough sailing over the next couple years. Please consider liking and subscribing if you enjoyed this content.